Good afternoon, everybody. Welcome to the September 5th, September morn. It's a great time of year in southeastern Michigan, and the weather is great, and I look forward to having a little bit of fun here today. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and I'm joined here by two very dear colleagues. First of all, my friend to the about a half hour north of me, Ken, I want to say maniacal mathematician of mid-Michigan.
Okay.
Magnificent mathematician.
We're just going to have to create
Can't you see the way he's leading us all in dance? He's magnificent.
You could go through the alphabet. He could be the great growth guru too.
There you go.
We just got to have to keep a side book of the different names that I have and continue
all the Norm DeGares that you have.
Time on it.
Either that or somebody could simply fix my teleprompter. If I had a teleprompter, we could fix it. Anyhow. And we're also, Ken and I are both joined here again by our special guest, Kevin. Je ne sais quoi, Gillogly. Welcome back, Kevin.
I never knew that Gillogly was French, but I guess it is.
It can.
My Irish family will be surprised by that.
All right, and we have used the McDonald slide before. Many of you have chimed in and confirmed that the red vehicle is a 1956 Ford. Yeah, so anybody wants to chime in on the other vehicle, please do so in the comments. I think we can have some fun here today with this. The thing that we discovered fairly recently was that we had all served as paper boys in our younger days. And I have to admit, my newspapers there on the far right, the Savannah Times-Journal and the Clinton, Iowa Herald, are nowhere near the same magnitude of Ken. Was the Cleveland newspaper the only one that you ever delivered?
It was the only paper I ever delivered, and I was a paper boy for 6 years. They gave me a scholarship at the end as I was going to college, and you can tell the price of college back in the good old days. They gave me a $1,500 scholarship, and that paid for almost all of my freshman tuition.
Wow.
So, yeah. At a private college.
And we also reminisced a little bit about the Scripps family has been very influential in the Midwestern newspapers, I believe also in Detroit.
Yeah, I started the Scripps as founders of the Free Press, which is I think it is the largest paper in Detroit today. The press is no longer around in Cleveland. It started as the Penny Press, and then it bought up the Cleveland News in the late mid-'60s, and then was out of business by the early '70s. So I think there's only one paper left in Cleveland today. It's the morning paper called The Plain Dealer.
Yeah, that's the only one that I'm familiar with.
Yeah.
And of course, Kevin, toiling in the suburbs of the Chicago area, he's got all the rest of them on the page. Tribune, Sun-Times, what became the Daily Herald, which is kind of the DuPage County adjacent to Chicago, and Wall Street Journal, Barron's, and Kevin,
the Chicago American before it became the Chicago Today, and the Daily Herald. It wasn't daily; it just came out twice a week, and it was also up in Mount Prospect. That's the northwest suburban Cook County. And there was also another local paper called the Mount Prospect Day, or the Prospect Day as it was called. So 2 locals and 4 other papers, 2 in the afternoon, 2 in the morning, plus the Journal and Barron's.
So were you having trouble holding down positions with these guys and they were going out of business, or what was going on there?
Yeah, I had that power. My little route in Mount Prospect had the power to shut down the Chicago. The Daily News went out of business when I was in college, and I wasn't delivering papers anymore. And as I was telling you, Mark, offline, and for those people that are playing along at home, if you tell something to Mark in a phone call or in a conversation, expect it to be in a bull session at some point later on. Yes, my dad, since I had the Sunday paper, He felt I probably needed to have a wagon to do it rather than walking around. The route was all around our house. He helped me get a wagon and the stuff to be able to put a cover on it, and then my dad charged me a vig for all the stuff until I could pay him back.
Neat. Neat.
Mom was
Mark,
livid.
Our audience, Mark, is telling us that if you remember Oldsmobile before it left the GM stable, their advertising used to be, recently at least, not your father's Olds. Well,
Yeah.
this is your father's Olds in the picture there. Right? The black car is an Oldsmobile, people are telling us.
Well, that helps us along. All right, so we do have a bunch of stuff to cover, but we are going to sneak in and share Kevin's story of investing in McDonald's back in the paper route days.
Ouch. Ouch.
And it won't be too painful, Kevin. It won't be too painful.
It's painful every time I look at it. It's sort of like that girlfriend that shuts you down in junior high or in high school, and you still lament over it. And people do movies about it all over for on and on.
The
So yes, this would be painful.
Well, you can always stalk her on Facebook. All right, here is our weekly reminder. Our weekly reminder that Portillo's is not sponsoring this broadcast, but they should be. All right, here's our standard disclaimer. No investment recommendation is intended. By the time we're done, you will have wished that you did invest in McDonald's back in 1969, but there's nothing we can do about that now without a time capsule. We're going to talk about real stuff in real time. Everything that we do here is for education, illustration, and demonstration. So please do your own homework. We will be sharing opinions, but do form your own opinion about any company that we mention, and all that stuff applies. Use what makes sense for you. We had our roundtable last week. We're actually going to spend a few moments with Ken's selection of Technoglass, but if you'd like to be added to a reminder list about the session, which will come up on September 26th, Tuesday, 8:30 p.m. Eastern Time, send an email to nkabula1@comcast.net, and we'd be happy to add you to that reminder list. We will not annoy you with millions of emails. You'll just get a couple just to let you know when those events go live. If you have any suggestions for future topics, questions, or would like copies of the slides, our two email addresses are down there at the bottom of the page. Anything else, Ken?
Nope, sounds good. The reminder for this month's roundtable, my wife was downstairs preparing it as we speak. So it's either gone out now or it's going out momentarily.
Okay. All right. Here's our quick check-in on the market barometers as we see them. And we take a look at the value line arithmetic average as a measure of the stock market. The reason we do that is we believe that fairly carefully represents all of the above investing in small, medium, and large companies, better than many of the major indices do, plus it's equally weighted. So you get the influence of 1,700 individual companies, again, of small, medium-sized, and large companies. And I did make one fairly significant change here, Ken. Can you spot it?
I didn't even take a look at it, Mark. So no, no, I didn't spot it. What is it?
Snuck it in here. I snuck in my par instead of a value line metric. So that is that is the manifest investing median projected return since the beginning of manifest back about 20 years ago, and you can see it right there. So that's what's shown here on the chart, highlighting it here. And again, it's going to be the same shape as the value line number that is usually there, the forecast from value line that's there. It's going to be the same shape with a little bit of differences, but I think you can see it's pretty much the same. We are missing a few years back here because that predates manifest. So again, we have kind of snuck back up in a fairly rapid way here in the last couple of days of the end of last week. Today seems to be different, but that light green bar on the right is back approaching that mathematically computer provided trend line, the blue line. Anything else you'd like to add there, sir?
Well, I think we could probably do 20 minutes on the MyPar line, but I think that today I want to think about it just a little bit. I do know that probably somewhere along that red line, we need to point out that Y-charts data became the standard source for what we were doing. So that probably makes a fairly decent difference in some of the way you look at some of the data, doesn't it?
It certainly brought the small and medium-sized companies up to date continuously. So there would be that change for sure.
Absolutely. Yeah.
All right, so let's keep rolling because we've got a whole bunch of stuff to cover. Here's just a couple of things. Love this one. Anybody who thinks they know what's happening tomorrow, Ben Carlson reminds us, basically going back a few months ago, who would have expected the NASDAQ to be up 40%, mortgage rates to be at multi-year highs, and housing prices increasing again? 700% of economists predicting a recession. And again, just like everyone predicted. And who can realistically, other than Herb Lemkool, say that they saw this coming? Because I actually wonder if Herb didn't see it coming. He actually selected NVIDIA for the round table a couple of years ago. So good stuff. And on the right-hand side, this is, as Matt Spielman has pointed out a number of times on the forum, this is Jerome Powell and the Fed's favorite look at inflation characteristics. And Matt, if you're still online, if you're still live, care to share any thoughts from 35,000 feet? What do you see? What are you thinking?
Well, I'll say my crystal ball is no better than anyone else's. I've felt pretty strongly about this and been writing about it for 9 months, but that doesn't say things can't change. And I definitely feel that pressure. If you ever make one good prediction, then the real trick is to make 2 in a row. So I worry a lot about how we come off of this or what it means to the housing market together. But I have one of my last pitches in the what inflation thread shows that in particular, the next 2 months for PCE, and keep separate the CPI number, which gets probably more headlines, and PCE, in particular core PCE, which is what the Fed looks at, they are going to lap the 2 highest months in the last 12 months. So August of 2022, if I have the order right, was a 0.6% month over month increase. In September was 0.5. And the last 3 months we've had, so starting in June, was 0.3, 0.2, and 0.2. So the last quarter has actually been a 2.8% core PCE growth. And it was much higher a year ago. And there was one in January, I think, but it's basically the last hurrah for what was last year's inflation news, call it that. So I expect, even if it was 0.3, that we'll go down another 0.5%. For natural causes. It'll simply age off the chart.
Right.
Unfortunately, after the next Fed meeting in September, but shortly thereafter. So there's of course there's lots of betting, even real betting, futures on what the interest rate will be, and or what Fed actions will be in particular. I strongly think, seeing that the glide's going to go down, if they did raise 0.25% and then suddenly we saw PCE went down again, they're going to have some explaining to do. I would, if it was me in their shoes, I don't pretend to guess what they do. I would say this would be a good time to let it ride, and then who knows what will happen in November. It might be up again or not.
Yeah, because they have another meeting in November or December, right?
Yeah. November. It'll be September and then November, and I think there's a good bet there'll be one more 1/4 point raise in one of those two, whether it's proximate causes, the recent, oil inflation, or who knows, some market goes up. But I think that would add to market volatility if they did it in September, while the numbers are gonna drop pretty rapidly.
Yeah,
Matt, I certainly have my thoughts, Matt, about housing prices going forward. You just kind of alluded to them at the beginning of what you were saying there. Where do you think housing prices are headed in the next, let's say, year?
Well, I think the next half year is not going to change much, because if the Fed keeps their rates up, I don't think mortgages are going to change much. And we talked about it a couple weeks ago. It wasn't Green Brick, but one of the home builder CEOs said that they could buy down, and a lot of home builders will buy you down in your interest rate for a year or two, essentially making the same bet that a lot of homeowners are, that you could refinance your mortgage in a couple of years here. But this CEO was specifically saying he could buy down the lifetime of the mortgage, not all the way to 3%, but to 5% for about $30,000. Essentially, it works into options and derivatives, or to get the equivalent change in monthly payments, which is what a lot of particularly first-time home buyers are looking for. They'd have to drop the price by $80,000. So there's an active arbitrage that technically anyone trying to sell a home in this market could do, but people don't generally have $30,000 to start with to play with it. But the home builders are taking full advantage of to more or less degree. So what I wonder about, and I don't have a conclusion about it, is if the Fed starts lowering, and so interest rates start lowering, because they're tied not directly to the Fed rates, but to the 10-year Treasury. So people see that rates are starting to come down, they're going to start betting how fast and how soon they'll come down. If that gets into the 6s or even the 5s, that might make some homeowners that are reluctant to move now jump and increase supply. At that point, I would expect a moderation in prices. That's kind of my very rough scenario thinking, my most likely scenario. But how much and when is still TBD. But I don't see that. I see that's a 2024 thing at least.
Well, very good. Well, thanks, guys. All right, so we'll keep our ear to the ground. I mean, the one thing I take away from all of this is I can go back and show you a ton of articles about run for the hills. The stock market's going to be in the toilet. A recession is certain. And we're sitting here. Anybody who actually went out and bought excellent companies when they were on sale has a sneaky smile right now. So good stuff. All right. So Kevin, let's have some fun here. Back in our Chicago days, I want to take us back to 1969. Once upon a time, when a certain young man had a newspaper route in Mount Prospect, and there was a big event that summer. Did you deliver that newspaper, you think?
I did, and I remember sitting in my backyard with our dad on a little portable TV, probably about 6 inches across, watching the man land on the moon.
Neat. Interesting.
And
stuff.
I had a scrapbook from all 4 newspapers covering the Cubs of '69. And since they disappointed me, I became a White Sox fan.
There you go. Well, I apologize in advance for any Chicago Cub fans here, because as a Cardinal fan, I do kind of enjoy this. Back in 1969, and by the way, full disclosure, full disclaimer, I actually really liked the 1969 Chicago Cubs. They had Fergie Jenkins, Ernie Banks, Billy Williams, and as shown here, Ron Santo. And for those of you that aren't familiar with the story, and it links up with Kevin's McDonald's moment here in a second, the Cubs had actually been in first place the entire season until September 10th, September 11th. And that is literally a picture from the Tribune of a black cat going across the on-deck circle in front of Ron Santo. Pretty sure that's Ron Santo. And
it is at Shea Stadium.
Is that at Shea? No, that's at Wrigley, isn't it? Or is it Shea?
No, because remember, they didn't play at night. That's Shea Stadium. That's their away jersey.
Oh, okay. Okay.
That's at Shea Stadium. They lost the Mets that day, and the Mets took the lead.
So we blame the Black Cats at night in New York. Wow.
So how old were both of you gentlemen in 1969?
Well, I was 10, and I had a paper route at the time.
I'm so much older than Mark. I'm like 6 months older than you, so I turned 11.
I'll tell you where I was at this newspaper time right here. I was on the banks of the Ohio River at YMCA Camp Robert Meacham, and we had about 250 8-year-olds through 12-year-olds in the dining hall, all trying to see the man on the moon land on a 12-inch TV, square TV in the front of the dining hall. So you were able to do it in luxury. I was doing it with children all around, and none of them very interested in the man on the moon, unfortunately.
Interesting times. So anyhow, that date stamps the moment for us a little bit. Here's just a little bit more. Kevin tells me that original McDonald's in the Chicago area in Des Plaines was it across the street from your house, or?
It was across, that Des Plaines is the next town over. That was across the street from my orthodontist, and it's still there. It's now a museum. All of the first, these are the first of the franchises. Obviously, McDonald's was started by the McDonald's brothers in California, but Ray Kroc took over the franchising of it. And since he lived in Des Plaines, the first, the 100th, and the 1000th were all purposely opened in Des Plaines.
Okay, didn't know that. So you're looking at
I've been to all of them.
Looking at a menu from back in that time frame. Those were pleasant days to stop in and get yourself a quick lunch or dinner.
Well, you got to remember, filet of fish didn't start in Chicago. It was actually a franchisee in Cincinnati, and because they couldn't sell burgers on, their numbers dropped on Friday because Cincinnati was a heavily Catholic town.
Uh-huh.
And so it became so popular that they opened that up and started doing it. Ray Kroc, being Polish, he tried things like a pierogi. That didn't work. He loved them. No one else did. But the fillet of fish came there, and then the chicken sandwich came out of the DC area.
Interesting, because we're going to point out here in a second that the Big Mac actually came out of Pittsburgh. So
that is true.
Interesting stuff. Yeah, great menu there. So anyhow, back in the late 1960s, that 1969 timestamp, that was the time when Kevin's dad and uncle teamed up to basically persuade Kevin to buy some McDonald's stock. And I apologize.
No.
This is probably a little bit of a painful picture for you, but
it's always painful to just discuss this. No, after I was done paying off my dad for the VIG, and I bought all the penny candy I could from the local pharmacy and all the donuts that were on the donut route so that I was there, and baseball cards, I still had money left over, and my dad suggested that I talk to my uncle, who was a researcher for one of the regional brokerage firms in Chicago, A.G. Edwards. And and they suggested that I buy some stock with my surplus funds, all of $150.
And so how did they work around the round lot, the 100 share requirement? How did that work out, Kevin?
Yeah, for those people who don't know, until we had discount brokers in 75, you had to buy in round lots or 100 shares. So that's the reason why dividend reinvestment was a great way to do things prior to 75, because you wouldn't pay the stuff. I didn't get charged the brokerage fee because that would have eaten up all the money, pretty much. So my uncle did me a solid by doing that. He apparently was able to bundle it. And yes, they even sent me the certificate with the 5 shares. I was able to buy 5 shares of the stock I bought.
Yeah, it was 22.5 at the time you bought it per share.
I did not buy McDonald's. They suggested I buy a good solid utility because of the dividend.
Oh, I didn't realize that. Okay.
Yeah, I bought Northern Illinois Gas, a gas utility company for that area. And I, didn't know better, but I would have liked to have bought something I knew, and I sort of thought of McDonald's, and I didn't.
And you were right. You were right, and the brokerage guy was wrong.
My uncle, my mom's brother, and my dad shanghaied me into buying a utility because that's the way to be able to make money. And they didn't even do dividend reinvestment. They said that way you'll be able to get a quarterly dividend.
Oh, great.
Yeah. Obviously, so, when you talk about investing, it's always great to have your big wins. But if you want to talk about the one that got away, this one got away.
All right, so let's talk about how much got away. If you take a look at,
This is going to be painful. Go right ahead.
okay, Kevin's Big Mac attack, that opportunity back in September 1969. Again, it was 22.5 per share for McDonald's on that date. Split adjusted, dividend adjusted, and corrected knocks it down to 15 cents per share. So, Kevin, your 5 shares would now be 1,000 shares.
Actually, it wouldn't be 5 shares because if it was 15, if we did that, I'd get 150, which would mean, so that would be what, 1,000 shares, 100
Well,
shares.
Anyhow, now it's definitely 1,000 shares now. So,
Yeah, no, so it wouldn't have been just the 5 shares because I would have been able to buy more. So yes, this is even more painful. That could be like 1.8 million. Thank you very much.
You're very welcome. So anyhow, the relative return, again, there's that magic 15% number, Ken. 15% over that long term for McDonald's, beating the market by nearly 8%. Again, a little more context, Big Mac. By the way, Ken and I were talking before we got started. I would have estimated the calorie count for a Big Mac at about 900. And amazingly enough, it's 590. But again, when we're thinking about how many Big Macs Kevin can buy with his McDonald's proceeds, it does depend on where you're buying it. Location, location, location. As shown there.
And with
right.
a 4%, I think it's like a 4% yield for McDonald's. So just imagine, again, I don't think it would be 180,000. I think it would be, I always felt it was going to be a couple million I missed out on. So call it 2 million, which would mean I'd be getting about $80,000 a year. And then if you take out taxes and stuff, I'd probably be clearing, I don't know what, $75,000 a year. Thank you very much. This is painful.
Tough to swallow. Here's the math as it works out on the spreadsheet anyhow. Again, pointing out that the Big Mac did originate in Pittsburgh back in 1967, and the original price was 45 cents. So that's actually gone up about 4% per year, the actual cost of a Big Mac. So the $150, if it had been invested in McDonald's, would have grown to be almost $300,000. And it's interesting that that actually comes out to be nearly 60,000 Big Macs, or enough for a Big Mac a day for 162 years, Kevin.
My cardiologist would be very proud of that.
All right, so we've beaten you up enough. I think it does demonstrate quality company. It kind of rhymes with what we attempted to do with the 2048 portfolio over the last few weeks. Good stuff. Hopefully that wasn't too painful for you, sir.
Well, nothing like being, ashamed in public.
Oh, if we want to do a shame session.
Ken, does he do this to you? Or is he saving this just for me?
I'm going to plead the fifth and go on to the next slide here, okay?
We're talking Big Macs and we're talking Portillo's, and you guys are missing the big news today. Today is National Cheese Pizza Day.
It is? Okay, well, we
Yes,
should have
it
a
is.
Domino's slide or something.
Or, just support your local pizza chain like I'm going to do tonight. Because they keep hitting me with their apps for get a discounted cheese pizza today.
All right. Well, thanks for the memories, Kevin. And sorry if it was painful at all. If we want to do a shame session, I have plenty of ammunition on myself that I could bring to the party. I'll tell you. A couple. Haven't done it lately, but over an investing career, you actually have some interesting moments. All right. So let's switch gears, talk a little bit, just a quick update on the utility bill auto pay demonstration portfolio. For those of you that are not familiar, we selected 5 utilities back in May 2021, and the intent was for them to generate enough with dividends to completely pay the monthly utility bill. So the 5 utilities are at the top there. We actually did end up getting taken out by an acquisition of South Jersey Industries at a handsome price compared to what we paid for it, so that was nice. And those are the current holdings in the portfolio. And again, the major thing is we want this column here to stay positive. It's basically the checkbook balance. And this is just a quick update. We did take the money from South Jersey and plow it into that income. It's a very special income ETF, JEPI, that casts off an enhanced monthly dividend. So it actually does bounce around, and you can see that the amounts for this JEPI dividend are actually a little different. They use covered calls to generate that. And you can see that our fairly recent payment coming in tomorrow or day after tomorrow takes us to $511. We have another payment coming in the middle of September from Next Era Energy, the quarterly dividend payment. So the stuff that's actually in the highlighted area at the bottom is budgetary. So in pretty good shape. I think it illustrates how income from investing can actually do something very, very tangible. Your thoughts, Ken?
I noticed JEPI in September was $80 and change. The forecast is $94 and change. Why the difference, Mark? Or is that 94 just a placeholder?
Yeah, the 40 cents per share is just an estimate for October, November, and December.
Okay, so that's just a placeholder. Okay, got it.
And that's based on an average of the last 12 months or so. So with the higher interest rate environment, we're actually seeing what these guys are able to do, and it's less than last year. So we're basically looking at a position, this JEPI, generating a 10 to 12% annualized dividend at this point. Again, the core holdings in that fund are just a basket full of blue chip stocks. Okay, so everything's going swimmingly, at least in that neck of the woods right now. All right, here's a quick update on the Groundhog leaders. A little bit of Ardelyx influence here. We do have a new leader. Nick Pacini and Ann have traded spots up at the top, but Matt continues up there. Ken and I are battling it out. I actually have a prayer that I'd like to say that I hope it isn't Ken versus Mark in the number 1 and number 2 slot the last day of the year, because I can't bear another moment like that. So if it comes down to that, I'll probably have to leave town or something. But again, a lot of very familiar club names on here also. So who moved up the most here on here? Looks like Pedro down at 40th has come up pretty good, and compared to last week, Alex Castor had a pretty good week. All right, any other thoughts?
You know what I feel about looking at this every week. I just think we jinx it. So let's keep moving.
All right, the monkey still is 151st out of over 170 entrants. So
that's great. I love that. That one you can put in big letters somewhere. Okay.
The dart tossing monkey, for those of you not familiar, 151st, because he threatened to win last year. All right.
I'm surprised at how much Kathy Wood is moving around, Mark. She's back up now to 105th from 120th. So I mean that ARC portfolio is just moving all over the place. I don't understand people that invest in that, but it's not my style, I guess. So we should.
I actually own a tiny number of shares of that fund, and I will tell you, Ken, I just simply put it in the desk drawer.
Well, that's, I think, what you have to do. I don't think it's making, very few of the companies are actually making money, Tesla being the prime exception to it. But.
Yeah, and she's also notorious. There's a bunch of articles out about it. She sold NVIDIA before the run-up, allegedly. I have not bothered to look. Like I say, it's in the desk drawer. So, yeah. All right. Here's a quick
look. Sounds like Kathy Wood should have been listening to Herb Lemcool then.
Yeah, she needs to spend more time with Herb, so it wouldn't be a bad thing. All right, we actually had a fairly decent week. We're having a really bad day today, so stay tuned for next week. But the companies in the best small company portfolio have retreated a little bit, but they had advanced. Basically coming up neck and neck with the Russell 2000 Growth Exchange Traded Fund. they have been trending better over the last several weeks. Let's hope that today's carnage isn't too bad for them. Here's a quick look at, if you want to go a little deeper on this one, and this is some of the conversation you heard between Matt Spielman and Ken as we went live here today. So Ken, would you like to describe how happy you are that you chose Technoglass for this year's Best Small Company Portfolio?
Well, it's the best performer. You saw the numbers, relative return of 77% at the moment. That number's been as high as 100 plus during the year. So it's certainly a great performer. And people have asked me, what do I attribute the back off in price to? Well, I think a really great example of people taking some profit and taking it off the table. This is not the kind of company that I would call core. This is not the kind of company that I would say I wanted a standard percentage in my portfolio of. You know, in a 20 stock portfolio, I like to have my great stocks all around 4, 5, 6%. I certainly wouldn't be looking for that much in Technoglass, at least not to begin with. So if you're going to play with this one, remember non-core, non-core, non-core. And Nicholson said keep the non-core to 20, 25% of your portfolio or less, and you shouldn't put yourself in any major danger over the run of the portfolio. These people make glass. All the glass you see in this picture, this is downtown Miami, and all this glass is made by Technoglass. Used to be a Colombian company, and now it's a United States company. They have moved their offices, their corporate offices. They've moved the whole thing to Miami. And one of the possible pluses of that move, besides being closer to their customers, they do 96% or more of their business in the US. But besides being closer to their customers, that might make them more attractive to be included in various ETFs, various index funds, now that they're a United States-based company. I don't know where we're going with this, so I'm just going to say next slide and see what happens, Mark.
Yeah, and again, I included it if you want to go deeper, because Ken spent a number of minutes giving the full background on the company at the August roundtable last week, and just wanted to remind everybody, if you want to catch that, you can access that on the YouTube channel at that.
I think the key word on that slide we just got off of is that they're an integrated company. They do it all, from the using the sand as a raw material to make the glass, all the way up to the doing the service on the glass after it's installed. My SSG results were amazingly consistent with manifest results. I like to do an independent analysis myself on the traditional SSG, and then I like to sit down and compare it to where manifest is. If I'm within 10, 15% of the manifest number, I'm feeling good. If I'm within only 40 or 50 or 60%, either direction, then a lot of times I'm rethinking some of my own decisions on the way to coming up with a final decision. There are times when I'll get stubborn, however, and I'll make sure that I ask Mark for him to do a re-look, is a nice way to say it, at one of the stocks, and I think we're going to do that in just a couple of minutes. But this one, I agree very, very closely with where manifest is coming, and that's, remember, manifest numbers are based on data that's coming from a commercial source, just like a lot of the numbers that you use are based on numbers that come from commercial sources, and that means that sometimes they're not as up to date, or they're not they're not going to be in the same place that you are when you think through your analysis. That you just have to be aware of that.
Yeah, and for those of you who missed it, and this before we actually got started with the session, Matt and Ken were talking about the backlog that the company talks about, the inventory situation there, and what impact is that going to have? What is the residential / commercial mix basically provide for the company going forward. And it's definitely some things to be looked at. And if we
one of the
go ahead, Ken.
One of the news items that just came out within the week is the fact that they've moved into vinyl windows for their residential customers. Their business is split pretty evenly, half residential, half commercial, and moving into vinyl windows for their residential customers is going to give them increased market, which might soften the blow if we do move into recession. Matt was talking about the fact that some of the early victims of a recession are buildings of a certain height, skyscrapers, and you see the building, the activity in that division kind of grind to a screeching halt when a recession comes in. Well, if Technoglass can not only increase its geographical footprint, which it's trying to do in big letters, it's moving into lots of other places in the U.S. besides Florida. If it can do that, and if it can move into some increasingly opportunistic places in the residential section of its business, that might give it enough of a cushion. I happen to think that housing has this double whammy from demographics that is going to keep the housing market stronger than we would anticipate it was going to be, only because the demand is so high from generation right now that is moving into homes. I think that's unique in our history to have the kind of demand that we have. Normally at this time, housing demand should be starting to dry up, and the demand just doesn't seem to be drying up at all. In fact, it seems to be moving the other way.
Kind of a reverse Harry Dent.
Yeah,
but just to say, Ken, I fully agree with you. My comments earlier today, notwithstanding on your question, I do think housing will moderate as interest rates moderate, and the existing home owners will loosen up. But this has been a problem 14 years in the making, at least, basically since the great financial crisis.
Yeah.
If you look at and we've talked about this in prior years anyway. If you look at the Federal Reserve and the Department of Commerce details on housing and compare that to household formation, we've been underbuilding for now going on 15 years, and we only just essentially met the replacement rate or met housing growth to meet household formation in 2021. So we talk about this as a spike, a white hot spike. Something will come down, something on the order of like travel's impact, meaning from the pandemic. And it's really only just healing from the last time. And this industry, which is a very investment heavy industry, got hit so bad last time.
Yeah.
Yeah, and there's an article out just today. I don't know if it was Goldman. I haven't had a chance to review it in any depth, but they were talking about paying ahead for commercial and commercial real estate. So I want to take a closer look at that and see what their case is. All right.
Yeah, Marty Eckerly makes the point, Mark. He assumes these vinyl windows that I'm referring to are vinyl frame windows. And Marty, you're absolutely right. Technoglass had provided all of its residential glass up to this point for a more expensive window, a wood frame or a composite frame, and now they're moving into a slightly less expensive window with various types of vinyl frames. This glass that they make is not the kind of plain old simple glass that might be in your home right now. This is quite sophisticated glass that serves the purpose of insulation. It serves the purpose of filtering light. And it does many other things besides the fact that a lot of it actually is bent. It's not just flat panes. It has a curve to it, or it has a flat place where the top curves into the building or something along those lines. Very, very specialized. If you're interested in what this company does, if you're interested in what I've been talking about, they have a series of investor presentations on their website. And besides that, they have one good, solid, recently produced investor show coming from just about 10 days ago. It's dated August 20 something. So take a look at it if this interests you at all. I think you'll be pleasantly surprised at the at how technical this company is, and you might say to yourself, well, it's really not a pure building trades play. It's a technology / building trades play, and it meets the what the new architects and the new engineers are looking for in buildings that go beyond where we've seen buildings before. We have a hand in the air right now, and I'm going to recognize, well, our friend Herb. Herb, I'm going to unmute you. You are. Go on, Herb.
Yeah, I just want to just make a note here that, remember, this is not a recommendation. Do your own homework.
Absolutely. Absolutely. And I'll say it again, like I said at the beginning, non-core, 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 danger, Will
All right.
Robinson. So,
Ken,
Yep.
Ken, can we go back one slide, Mark?
Sure.
You know, you have said, yeah, it's non-core. And I know you talk about this, Ken, where you sit there and you tend to look at, you know, on your SSG where you get the par. Here you have it at 29 or 24.9, and that's really close to what the par is on Manifest. If you look at the top end where you have a total return of 35.8, do you get concerned when that number gets too high? Is there a number that you find that's too high?
I don't watch that number, Kevin, nearly as much as I watch the upside downside ratio. And I will say that this upside downside ratio at 9.5 to 1 is probably as almost as high as I would allow it to be without readjusting numbers on my SSG. I won't stand for an SSG with anything over 12, 13, 14 to 1. And even at 9.5 to 1, I'm a little bit antsy about it. But what I tell myself and what I say in presentations is, you know, what if it only proceeds forward at 2/3 of the rate I thought it was going to? You know, what if I give it a 33% haircut? Well, that's still a pretty decent return. That's still a 20% plus return at the total return number, and I'll take it, you know?
Okay.
All right. And here's our reminder for those of you that may not be familiar with the roundtable. We do encourage the audience to vote for the stocks that are presented that evening. And you can see there was a consensus selection of Technoglass at the August session. All right.
And I think a lot of it was because Ken had his pom-poms out and was really pushing it hard.
Well, yeah, we deal with that on a monthly basis, Kevin. So we just kind of nod and, you know, move on.
Well, I think we may have to come up with a new acronym with all those pom-poms he was holding.
Just sounds like sour grapes to me. That's all.
All right. Back to more serious stuff. Regional banks. Everybody, moment of silence. No. This is one that's actually in the roundtable tracking portfolio. It's actually in our tin cup model portfolio. I've been speculating that, like we're about to show for a lime company, that the analysts tracking this company have been quite pessimistic. I understand why they got pessimistic. They're just not coming out of the doldrums very fast. I mean, here's the revenues for this bank, taking that nice little plummet for the first time in many, many years, back with what happened a few months ago, and when we had the bank failures. That does seem to be turning around, and as we watch their numbers down below here, they're kind of slow to turn around. Some of the major bank analysts that track them for fund investing and that type of stuff seem to have turned a little bit more than that. So I just think it's an example of the potential overreaction. We're looking at a company that has very steady book value growth over the years. This return on average assets is exemplary, and this is a bank with a pretty solid reputation. So I expect recovery. I could be wrong, but Ken, how do you see the situation now after it's been percolating?
I see exactly what you're saying, Mark, that they're thinly followed, a lot of the smaller regional banks. They might only be followed by, 2 or 3 or 4 analysts, and analysts like to feel secure, which means that they'll move in herds a lot of times. I just don't think they've given enough thought to where things might be going, and I think right now they've ticked the box for worst possible future conclusion on everything. They're talking about you're going to have to hold more money for bad loans. You're going to have to hold more money because the government's going to change the regulations. You're going to have to do this and that and everything. And I think a lot of the analyst community right now is assuming every single one of those things is going to be true.
Mm-hmm.
And it's going to really destroy the regional bank. And I'm just not certain that that's going to happen. I'm going to depend more on the numbers and, show me that it's going to happen before you predict out into the future. I think you have one more slide showing what they earned.
That's for the lime company.
That's for the lime company. Okay.
But it's a
All
good
right.
example. I think it applies here also, because I do think
Yeah.
recruiting is largely stopped, and
Yeah.
triage has been effective. So we'll see. It is a matter of time. All right.
And price to book for a lot of these banks is still by historical standards extremely close to 1, which it shouldn't be. Price to book shouldn't be under 1, and it even close to 1 is something you don't expect to see in a good high quality bank. So when you're seeing those kind of things, I think it just denotes pessimism coming from all sides. And we know that pendulum between optimism and pessimism swings. And we know that very often, especially in small and medium-sized companies, that pendulum swings way too far in each direction. So let's just be patient and not throw everything away with thinking that the sky is falling right now, at least.
And in case any of you are out there wondering, Kevin, I'm taking off my shoe and I'm pounding on the table. I'm still holding my Western Alliance shares.
My club is doing it too, and we actually have positions. Both of my clubs have positions in Service First.
There you go.
I also belong to a club with a position in Service First. So,
all right, here's our Sweet 16. We just want to close out with a quick look at a couple of the features that we currently are working on. This is the curse of Green Brick Partners, because I put this out and the stock dropped 10% this morning. But these are the companies that were ranked with the best return forecast and the best quality rankings in the universe of companies that we follow. A lot of very familiar names. Kevin, your darling, is on here. Just a lot of and Taiwan Semi was recently presented also. So some pretty decent studies there from top to bottom.
I still see your Service First. I still see your Service First slide. I don't see your newer slide.
Oh, did it not advance?
No,
I don't know.
Mine did.
Yeah. Okay.
I must admit, Mark, I'm especially intrigued by the fact that Visteon makes a list like this. But
I know there's the auto parts companies are in the middle of some fairly significant corrections to moderate forecasts, and they're still ending up. Linamar's another automotive company. Maybe Matt has a comment on what the industry is seeing right now, because a lot of these companies are showing up on screening results.
Well, at least Linamar has a value line low total return number that's believable for a set of top companies. But I look at Visteon, and boy, value line is certainly pretty negative on the company as far as return is concerned, not as far as the company is concerned, but as far as the performance of the stock.
And one of the things that you were just talking about, Ken, as you go down this column here, this ACE price to fair value, you see some pretty aggressive optimism here. And then, and right next door, I can't even explain how you can have these two numbers at the same time. So we're going to actually take a look at a company here. And this is the one you mentioned just briefly, Ken. This is actually comes from your club. Do you want to set the stage for this?
Yeah, we've been studying building materials in 2 of my clubs. And in one of the clubs, after we finished our study, our guy, Ken Krozak, who manages our contest portfolio for the Mid-Michigan stock contest, said, you know, we have a stock in the Mid-Michigan portfolio, US Lime, that is really doing extremely well, and yet you don't show it at all in the study. Why not? And we went to Manifest, which we use as kind of a crutch to help us narrow the field for our industry studies. And Manifest was showing a negative projected return for this company. You can see that this is prior to Mark making any adjustments, and you can see that par down there kind of in the middle of the list at negative 10.2. And I said, you know, the SSG looks really good. The only thing that I can say is that it didn't make the cut and as best in the industry because of this negative par number, and then associating that with the quality rating as well, which is only in the 50s. So, and then I wrote a note to Mark, and I said, Mark, we had a number of different folks do SSGs on this company, and we can't duplicate anywhere near your number of negative 10.2 par. Can you help us out? And Mark, I'll turn it back to you at that point then.
Yeah, and I think the audience can see, we do incorporate forward-looking estimates for companies in the work that we do. So for 23, 24, 25, for both sales and earnings, just quite a downdraft. Now they could be right. Let's get that out there right now. They could be right about that. And if they are, then everybody forget that you ever heard this conversation going forward. But it appears to me that that's at least out of line, and I'd want to dig in deeper to see what, can they actually back that up? How many of them are involved here? And it turns out in this case to be a relatively low number of analysts. So that kind of comes into question. And then, as you basically look to the next update, here's the box from Value Line showing the quarterly results. The numbers for June were actually landing. And you start pumping these numbers in down here for earnings, down here, and notice that the 74 actually did come home to roost. So the next number in this series is 74. I'm not seeing a huge downdraft in this company. And then as you read up about it, you just got to kind of scratch your head a little bit. So I say, what if we set those numbers aside? Let's just call those animals rhinos that are basically checking out or taking some time out, just simply need a little bit of recalibration. When you do that, it does make a substantial difference. I mean, obviously, that's a different picture. And this picture here is consistent with what we're seeing. Again, go back to that disclaimer that those rhinos could be right about what's going on, but I'm not seeing any sign of it. The change in numbers basically takes it back to a decent projected return. So we did make that adjustment that we would just like to set those possibly sleeping or slumbering rhinos aside for a while and see what happens. And it's just an example of how auditing something and digging in deeper to the numbers can lead you to a different point.
Well, and Mark, also we should make the point that changing estimates on sales changes the position of that sales when you compare it to the industry sales. And notice the quality rating, how it's
definitely
altered itself in that whole process. It's gone from the mid 50s to the mid 80s. And that's something that my clubs at least watch pretty closely. And again, there's nothing, we can't say for certain that these people that are making the analysis are wrong, but there's not very many of them. And so far, the data for this fiscal year isn't matching where they say this fiscal year is going to end. It's just not matching.
Yeah, unless there's something significant in the third and fourth quarters that we don't see coming. And I don't know. Yeah. The company is not giving any indication of that type of expectation. So we'll see. All right. Last couple of things I wanted to make a point on. Tin Cup. We basically accumulated in mode, and just in time for a 10% drop in the stock price. I swapped out MDC for Green Brick Partners. I'm just more comfortable with Green Brick Partners managing my capital in this situation. We picked up several percentage points in the long-term portfolio. As Ken knows, we get ice cream every time we break through another $1 million milestone. Well, we've had ice cream, I think, 6 times now for $4 million, and we just dropped below $4 million again. So we're hoping for ice cream again.
All right.
All right. So that's the changes that were made this month in the portfolio. Oh, and one element of stubborn, we actually accumulated a few more shares of MP Materials, because if we liked it at 40, we really like it at 20.
Okay.
All right. All right.
That's a Peter Lynch line if I ever heard one.
Sounds reminiscent of a song that I sang a while ago, Mark.
All right. As far as coming attractions, we do have all these still coming at you. Working on the funds that are behind the thrift savings plan. Ken wants to talk about hydrogen in cars. I really look forward to digging in deeper. Meb Faber is a really, really smart commentator on investing. And I just like the whole notion of, do we really look at the dividend concept properly? And we'll see where that goes. But those are in our future.
Yeah, Mark, I just want to say about the hydrogen car there. I've been very interested in some of the things some of the Republican presidential candidates have had to say about EVs, electric vehicles, and about, are we just trading oil problems for lithium problems? Are we trading problems in the Middle East for problems in China? And I'm not going to give any opinion or credence to any of that argument. You're going to have to think that through yourself. But every time I hear arguments like that, I say to myself, we have other forms of energy besides worrying about creating batteries to run electronic vehicles. And I go to hydrogen. If we can get a handle on hydrogen, we might have vehicles, and they're actually on the road today, and they're in factories today, doing the job that they're supposed to do, and doing it with no emissions of any kind, and doing it with no emission fuel, which was created with virtually no emissions. So I think that hydrogen is a real interesting thing for us to take a look at. Our politicians don't either they don't understand what the process is, or they don't know about the process, or there's some other nefarious reason. And I think to be nefarious, sometimes you have to be wickedly intelligent. And that's enough said on that.
I better bail you off before you get in too deep here.
Turn my sound off at this point. Okay, here we go.
Ken, put down the shovel.
All right.
There is already a company out there doing a full-on commercial demonstration of trucking and the use of hydrogen. So I'm sure that's one that
not only that, Mark, they've opened an actual plant which is manufacturing this hydrogen, which you can use for a fuel. You can go see pictures of it. The Georgia plant is now open, and they will have one open in Texas in the next 3 months. The name of the company is Plug Power, PLUG. Again, non-core, danger. But some of you might want to look at their investor presentations and take a little bit to at least educate yourself on the fact that there is other ways to fuel an engine besides a battery or besides fossil fuel, and you don't have to resort to nuclear fission or fusion in order to get there. We're talking about just burning plain old hydrogen which in the best circumstances you can get from water.
Yep. Good stuff. Although I'm still in the fusion camp and hopeful for fusion. Here's a reminder that we do.
Fusion is where I'm going too, Mark. But we're not going to get there real quick. So
yeah, quicker the better. All right. Here's the just your quick reminder that we do archive all of the roundtables and bull sessions, and pretty good session in August. Voted for the wrong company, but if you want to see a vote for the right company, go back to July. All right, so I thought we would close with a kind of a little bit of a celebration. This came up on my feed this morning, and it's something we have talked about. Ken, you may recall you were at a Super Bowl party where we were serving up Burning River beer during the Super Bowl party, and
from Great Lakes Brewing, yeah.
Yeah, and you explained that you knew a lot about this, so why don't you take us away here? I think this is a great tribute to the fact that there are aspects of the environmental challenge that we have met head on.
Well, first of all, if you think you can pronounce the name of the river, the folks right by the river can't even agree on how to pronounce it. So it's either Cuyahoga or Cuyahoga, depending on what part of Cleveland you live in,
Which side
and whether
of the river.
or not you listen to what side of the river you're on, and whether you listen to the guy that sang the song about the burning river that became famous. That's a picture of the major river that Cleveland was founded on, that flows into Lake Erie, one of the few large rivers that flows directly north on this continent. And it was set on fire in the late 70s. Oh, you got a date on it, 78, okay. And they had to bring in teams to put out the fire. That's a recent picture of the downtown skyline of Cleveland, showing an 8-man skull on the same river. The river is now flowing through a national park in a almost pristine fashion. They've taken out a lot of the dams and concrete spillways they used to have on the river, and they've created a national park. It flows through downtown, and you can actually see the bottom of the river at various points, and it flows into a pretty clean Lake Erie. If you were growing up in Cleveland in the 60s, as I was, you would never have even thought about swimming in the Cuyahoga. And you had to think 3 times before swimming in Lake Erie anywhere near Cleveland. Today, the recreation opportunities on the beaches around East Cleveland, West Cleveland, and the city itself are numerous. The lake is relatively clean. The river is even cleaner than the lake. They make a big deal about the water flowing into the lake is cleaner than the water that's in the lake. And for those of you that are pessimistic about the progress being made on our waterways and cleaning up problems that were created in the 20s, 30s, and 40s and 50s, Cleveland is a shining example of what can be done as you begin to work. Mark tells me that somebody sticking their hand in the river at the worst of the times and coming out just covered in sludge. So from that to being able to row a scull, I went to a college where we had rowing teams, and I can tell you that you don't put a boat like that in a dirty river because the first thing that happens is it sinks. So it's just a very positive story. And I wish sometimes we balanced some of the negative Cassandra views that we have about everything going on with just a little bit of positive news, that we don't mess everything up for good. Sometimes we do manage to get a fix in there occasionally. And when we do, we should celebrate that as much as we celebrate some of the problems. Joe says, is that black snow? I don't think so, Joe, but I will tell you that snow that came down in the 40s in Cleveland from the steel plants that were there. Had a gray tinge about it. You had to live a good 8 or 10 miles outside of the city before you got good solid white snow. So things have changed a little bit in this city, at least.
I will tell you that Wendy and I, my wife Wendy and I, spent a wonderful day. There's a park just east of the river with waterfalls and hiking trails. And if you're ever in the Cleveland area looking for a place to stretch your legs, I would cast a vote in their general direction for sure.
That's the Cuyahoga National Park, Mark. It's a national park. Yeah.
Yeah, it's a great place.
Cuyahoga Valley National Park.
Good stuff.
Just not to make sure that Chicago doesn't get blotted out by Cleveland. The Chicago River used to flow north, and they ran into the same problem about 70 years earlier. And the geniuses in Chicago decided to reverse the flow of the Chicago River, run a canal so it connected to the Illinois River so that all of our wastewater stuff would make its way down to St. Louis. That's what we did in around 1900.
There you go. Wow. All right.
Because we were using Lake Michigan as our drinking water. And we'd have the same problem that they had in Erie.
Absolutely. Anything else, Ken? And while we're closing down, I'll give a shout out to the Heart of Illinois chapter. Stephen Emmerich is still with us. He actually has a little get together tomorrow. Steve, I'll unmute you if you want to mention your session tomorrow. What's on the agenda for tomorrow? He may have left us.
Oh, there I am. Thank you.
Hey, Stephen.
Well, we're going to talk about the top 40 from the My iClub. There's a little section that we don't use very much,
Okay.
and it's called. It has the top 40 in it. It's called the Investment Club Hub. So that's where we're going to start. And if you want to join us, go to the Heart of Illinois chapter's webpage, and we'll certainly like to have you.
All right. Thanks, Steve. Anything else, Ken?
No, Mark. This has been an interesting bull session. I appreciated the relaxed nature of this particular bull session. Okay.
Well, you can blame that on Kevin Genesequa Gillogly.
Okay, I will do that. Okay. Hey, Kevin, thanks for helping out. We always appreciate it. And Matt, thanks for your thoughts as well.
Yep, it's always fun.
Thanks, everybody.
Good night. Good afternoon.